Let me start with a simple question. Have you ever checked your bank account and wondered, why am I working harder, but getting nowhere? Now imagine that feeling across an entire country. Because in late 2025, American households are carrying $18.59 trillion in debt. Not government debt, not Wall Street debt, regular people's debt, mortgages, student loans, car payments, credit cards, the everyday cost of trying to live a normal life. And this number didn't explode overnight. It's the result of a system where borrowing slowly became unavoidable. Want a home? You need a mortgage. An education? Student loans. A car to get to work? Auto loans. Groceries and emergencies getting expensive? Credit cards. Debt isn't a mistake anymore. It's the default. But this story goes deeper than just a big number. Because this debt shows up in real life. In delayed marriages. In adults with good jobs living paycheck to paycheck. In families doing everything right and still falling behind. So what's really happening? This isn't about blaming people for spending too much. It's about understanding the system behind the borrowing, how lenders operate, how rules are set, and how rising costs quietly outpace wages. Because consumer spending makes up about 70% of the U.S. economy. That means household financial stress isn't a side issue. It's a warning signal. And even though unemployment looks low and wages appear to be rising, something doesn't add up. Why does it feel harder to breathe financially? That tension between what numbers say and what people feel is why this matters now. In the sections ahead, we'll break it all down. Who carries this debt? How we got here? And what it means for everyday life and the future. Because the real question isn't just how much debt Americans have. It's this: how long can this system keep going before something breaks? Before we go any further, we need to understand how this whole debt machine actually works. Because consumer debt in the US isn't random. It's not chaos. It's an ecosystem. A living, breathing system made up of three main players. People who need money, institutions that provide it, and regulators who try, sometimes successfully, sometimes not, to keep things fair. Once you see how these pieces fit together, a lot of things suddenly start to make sense. Let's start with the most important group. Consumers. Regular Americans. They are the engine of this system. But here's something people often forget. Borrowers are not all the same. Debt looks very different depending on where you are in life. If you're in your early 20s, debt usually means student loans. For many Gen Z and younger millennials, borrowing isn't about luxury, it's about access. Access to education. Access to opportunity. In fact, about 92% of student loans today are federal loans, meaning the government itself is the main lender. Then life moves on. You get a job, maybe start a family. Now debt shifts into new forms. You need a car to get to work, auto loans. You want stability, a mortgage. And through every stage of life, there's one constant companion: credit cards. They're flexible, fast, and always there when cash runs short. But something changed in the early 2020s. Inflation hit hard. Even though inflation cooled down to around 2.5% by 2025, the damage was already done. Prices jumped much faster than wages ever did. Groceries, utilities, healthcare, insurance. So for millions of households, debt stopped being a choice and became a bridge. A bridge between income and survival. That's why credit card balances keep rising. Not because people suddenly became reckless, but because everyday life got more expensive. And then there's the psychological side. Debt isn't just math. It's influenced by constant marketing, social pressure to keep up, one-click approvals, buy now, pay later buttons that don't feel like real debt until they are. What starts as a short-term solution slowly turns into long-term stress. Because for every borrower, there's someone supplying the money. And the lending world is huge and layered. Big commercial banks like Chase, Bank of America, and Wells Fargo sit at the center. They handle mortgages, auto loans, and personal credit. Then there are credit card networks, Visa, MasterCard, Amex, working with banks that issue the cards and set the rules. The government plays a massive role too. The U.S. government is actually the largest student loan lender in the country. Agencies like the FHA and VA also back millions of mortgages, shaping who qualifies and on what terms. And then there's a darker corner of the system. High-fee lenders, payday loans, title loans. These target people with limited options and charge them the most. Here's the key issue. Lenders price risk using credit scores. Sounds fair in theory, but in practice, It means the people who can least afford debt often pay the highest interest rates. Credit card APRs over 24%. Auto loans hitting 15 to 20%. Late fees, annual fees, penalty rates. Debt becomes expensive, which makes repayment harder, which damages credit, which makes future borrowing even more expensive. That's the trap. That's where regulators come in. The Federal Reserve controls interest rates, and when inflation exploded in 2022, the Fed raised rates aggressively. That made borrowing instantly more expensive, especially credit cards. Later rate cuts helped a bit, but the damage lingered. Then there's the Consumer Financial Protection Bureau, the CFPB. They're the watchdog. In recent years, they stepped in to cap excessive credit card late fees and crack down on abusive practices. Other agencies monitor banks, mortgages, advertising, and fraud. But here's the truth. Regulation always lags reality. By the time rules change, millions of people are already stuck dealing with the consequences. That $18.59 trillion isn't evenly spread. The biggest piece by far is mortgages, over $13 trillion. Housing dominates American debt because housing dominates American life. Auto loans come next, and this is where things get sneaky. Car prices rose. Interest rates rose. So lenders stretched loan terms, 6, 7, even 8 years. That keeps monthly payments low, but traps people longer. By 2025, nearly one-third of car buyers owed more than their car was worth. Student loans remain one of the most stressed categories. After pandemic payment pauses ended, delinquencies surged. And then there are credit cards, the fastest-growing debt of all. High interest, short-term, no forgiveness. They're the financial canary in the coal mine. Debt hits different depending on who you are. Gen Z and millennials carry student debt that delays everything: homeownership, savings, even family planning. Lower-income households rely on credit just to survive. For them, debt isn't about building a future, it's about making it through the month. Middle-income families, once considered stable, are now stretched thin. Big mortgages, car payments, rising costs. And then there are subprime borrowers. Roughly 30% of American adults. They pay the highest rates, face the harshest terms, and are most vulnerable to predatory lending. Once you fall behind, climbing out becomes incredibly hard. And when you layer race, income, and credit history together, the burden multiplies, especially for communities historically denied access to wealth-building opportunities. So when you step back and look at the full picture, one thing becomes clear. This isn't just about people borrowing too much. It's about a system under strain. Consumers borrowing out of necessity. Lenders balancing profit and risk. Regulators struggling to keep up. And the pressure is building. Because when debt stops being a tool and starts becoming a permanent weight, the consequences don't stay personal for long. They spread. Chapter 2. The Evolution and Geography of U.S. Consumer Debt. To understand how America reached $18.59 trillion in consumer debt, we need to do two things. Go back in time and look at the map. Debt didn't appear all at once, and it doesn't affect everyone the same way. In some areas, it's student loans and sky-high rent. In others, it's car payments that never end. Same country, very different realities. It all began with the 2008 financial crisis. The housing bubble burst. Banks collapsed. Millions lost homes and jobs. Household debt fell briefly, not because people were smarter, but because credit dried up. From 2010 to 2019, the Federal Reserve kept interest rates near zero. Cheap money made borrowing easy, monthly payments manageable, and risk distant. Mortgages and auto loans grew, but the biggest explosion was student loans. College costs rose with almost no breaks. Debt increased, but low interest rates hid the danger. Then came 2020. The pandemic shut down the economy. Stimulus checks, student loan pauses, mortgage forbearance, and extra unemployment benefits temporarily eased debt stress. But beneath the surface, pressure built. Supply chains broke, demand snapped back, and inflation surged, peaking at 9.1% by 2022. Food, gas, rent, utilities. Prices rose faster than wages. Families borrowed more. Credit card balances surged just as the Fed began raising rates aggressively. A brutal double hit. More credit was needed, and it became more expensive. By 2023, interest rates were at decades-high levels. Minimum payments climbed. Delinquencies followed. By 2025, inflation cooled, but the damage was done. Debt hit a record high. Student loan payments resumed, and defaults spiked. Debt isn't uniform. Student debt is highest in high-cost urban areas, Washington, D.C., Maryland, Virginia, Georgia, where rent, childcare, and living costs are crushing young professionals. Milestones like buying a home, starting a family, and saving are delayed. Auto debt hits rural and suburban areas differently. Cars aren't optional. Loan terms stretched to 7 to 8 years lock people in. By 2025, nearly 1 in 3 drivers owed more than their car was worth. Losing a car can mean losing work. As debt consumes more income, spending changes quietly, eating out less, delaying vacations, buying cheaper brands. A split economy emerges. Some move forward, others tighten every dollar. Consumer spending drives most of the U.S. economy, so when millions pull back, the effects ripple outward, quietly, gradually, then suddenly. This crisis wasn't accidental. It's shaped by policy, economic shocks, and timing. It's many crises at once. Student debt crushing urban professionals, auto debt trapping rural workers, and a growing spending squeeze reshaping daily life. Different places, different pressures. Same question: how much longer can households bear this weight before the system itself feels it? Up to now, we've talked numbers, trillions, rates, charts. But debt isn't just numbers. It lives in people. Sleepless nights, anxiety at the grocery store, conversations couples avoid because money is too stressful. In 2025, money is the #1 source of anxiety for Americans. Nearly 7 out of 10 report feeling overwhelmed. It's not about luxury. It's impossible choices. Do I pay the student loan or the electric bill? Do I make the credit card minimum or buy groceries? Half of student loan borrowers face this every month. Debt affects health, insomnia, anxiety, depression. It strains relationships. People hide it, stay in jobs they hate, and feel trapped. But the quietest impact is the life you don't live. Homeownership delayed, families delayed, retirement savings delayed or skipped. Debt pushes people from meaningful work to jobs that just pay. Passion and purpose take a back seat. Money sent to lenders in your 20s and 30s never compounds, echoing for decades. When millions feel this pressure, the economy feels it too. Credit card delinquencies are near 14-year highs. Auto loan defaults rising. Student loan delinquencies spiked. Banks react fast, tightening credit, raising standards. Even people doing okay lose breathing room. Auto repossessions rise, negative equity traps grow, student loan stress drags generations. Consumer spending slows, and it drives about 70% of the U.S. economy. This isn't hopeless, but solutions require 2 paths, personal and political. On a personal level, prioritize high-interest debt, avoid minimum traps, use consolidation carefully, treat credit as a tool. On a policy level, debates continue on student loan restructuring, interest caps, debt relief, wages, and costs. Every solution has trade-offs. Doing nothing also has a cost. When debt becomes permanent, it changes finances, lives, dreams, and eventually the economy. The real question isn't just how high debt is. It's this: do we want a system where debt is a bridge or a cage?